investor webinar. My name is Brandon Chow, and I am the Investor Relations Manager of Xebec. I'd like to remind everyone that this webinar is going to be recorded and will be made available in the Investors section of our website later today. Please note that we will open the floor to questions after the conclusion of the presentation. If at any time you have a question, you may type it into the console on the right of your screen. Joining me today will be Chief Executive Officer Kurt Sorschak, our Chief Financial Officer Louis Dufour, and our Chief Operating Officer Dr. Prabhu Rao. Our earnings press release was issued earlier today before market open. All relevant documents are available for download either from the Investor Relations section on our website or from SEDAR directly. You will also find later today a copy of today's slide deck on our website's Investor section. During this call, we will make forward-looking statements about our future financial performance and other future events and trends, including guidance. These statements are only predictions that are based on what we believe today, and actual results may differ materially. These forward-looking statements are subject to risks, uncertainties, assumptions, and other factors that could affect our financial results and the performance of our businesses, which we discuss in detail in our filings, including today's earnings press release and the risk factors and other information contained in the final prospectus relating to our recent offerings. Xebec assumes no obligation to update any forward-looking statements we may make on today's call. With this, I turn it over to Kurt.
Thank you, Brendan, and welcome everyone to the most attended quarterly conference Xebec has hosted to date. At the last count, we had over 350 registered attendees for today's webinar. Let me start off by saying how proud I am of what the team has delivered for the year. This marks the third consecutive year of strong revenue growth, and our Q4 was yet another record revenue quarter. We generated $49.3 million in revenue in 2019, $6.3 million in adjusted EBITDA, and $2 million in net income, the best result since we went public back in 2009. The past year has been challenging for the team on many fronts. Growing our manufacturing operation by triple digits while remaining profitable is a solid achievement. Scaling the organization, buying and integrating companies, developing new and improved products while at the same time implementing a new ERP system and working on improving our internal financial controls to be in line with 52109, which will allow us to uplist to the TSX main board later this year, requires a lot of hard work, commitment, dedication, and focus to detail. All this gives me confidence that we can continue executing on our strategy of profitable growth by scaling our operations in the years ahead. I'm happy to report that our team continues to grow stronger as we build our organization and strengthen our management capabilities from team leaders to managers, directors, vice presidents, and the C-suite. With everything we have done in 2019, Xebec has set itself up for another record year in 2020. The company is in a much stronger financial position with an improved balance sheet, a significant cash position, and low debt. While operationally, we are going into 2020 with a record order backlog of almost $100 million and almost $1 billion worth of quotes outstanding. The two successful bought deals that we have concluded in 2019 have positioned us well, especially for times like these. They left us well capitalized and in a solid position compared to many of our competitors. And as we all know, in today's environment, cash is king. Also, the world backdrop is concerning and the crisis is taking a considerable health and economic toll. I still remain positive and excited about our opportunities and all our ongoing initiatives. Presently, we continue to work on our 2020 acquisitions. We continue developing significant partnerships that will help us fuel our future growth. And I'm particularly excited as we continue to strengthen our management team so that we can execute on our strategy of profitable growth and shareholder value creation. With this, I'll turn over to Louis Dufour, our Chief Financial Officer, who will go over financial highlights. Louis, please.
Okay, thank you, Kurt, and welcome everyone joining us. Let me start by reviewing our consolidated financial results for Q4 and the full year. As Kurt discussed, we achieved record revenue of $13.6 million in the fourth quarter of 2019 compared to $6.1 million for the same period in 2018, a 123% increase. We had revenues of $49.83 million for the 12-month period ended December 31st, 2019, compared to $20.2 million for the same period in 2018, a 144% increase. The increase is mainly explained by the higher volume of major clean tech contracts and the revenue additions of CAI, which we bought at the beginning of 2019. Our gross profit was $4.1 million in the fourth quarter compared to $1.5 million for the same period in 2018, a 173% increase. Our gross margin as a percentage of revenue significantly improved from 25% to 30% over last year's quarter. The annual gross profit came in at $15.5 million, or 31% of revenues, compared to $5.7 million for the same period in 2018, a 172% increase compared to the same period in 2018. The company had higher gross margin in the clean tech segment and a better absorption of the overhead costs due to higher volumes of sales. Selling and administrative expenses were $3.6 million in the fourth quarter compared to $2.3 million for the same period in 2018, a 58% increase. Selling and administrative expenses increased by $4.1 million in the 12-month period ended December 31st, 2019, compared to the same period in 2018. This is primarily due to the organizational scale-up and associated costs to support the increased level of sales, order backlog, and building quote log. Acquisition costs related to the acquisition of CDA system and additional costs associated with other acquisition activities, and legal expenses related to the establishment of our infrastructure segment increased SG&A expenses in the fourth quarter of 2019. A significant cost factor in Q4 2019 was the amortization expense of intangible assets of almost $1.3 million. A financial metric we monitor is our selling and administrative expense as a percentage of revenue, which was 26% for the fourth quarter compared with 38% for the same period in 2018, a decrease of 12%. This decrease is similarly reflected in our 12-month period ended December 31st, 2019, where the percentage was 23% for 2019 and 36% for 2018. This represents a significant decrease and showcases our ability to scale the business and realize efficiencies. Our long-term target is to have SG&A at 15% to 17% of revenues. We had positive EBITDA at $1.4 million for the fourth quarter 2019 compared to negative EBITDA of $0.8 million for the same period in 2018. For the 12-month period ended December 31st, 2019, EBITDA came in at $5.1 million compared to a negative of $1.9 million for the same period in 2018, an improvement of $7 million. In addition, adjusted EBITDA came in at $1.9 million for the fourth quarter 2019 compared to negative $0.8 million for the same period in 2018. The adjusted EBITDA of $6.3 million for the 12-month period ended December 31st, 2019, compared to a negative $1.2 million for the same period in 2018, an improvement of $7.5 million. The net loss for the quarter was 0.5 million or 1 cent per share compared to a net loss of 1 million or 2 cents per share for the same period in 2018. For the year, we are showing a net profit of $2 million or 3 cents per share compared to a net loss of 2.9 million or 7 cents last year. An improvement of 4.9 million. The increase is mainly due to higher sales and margins and a reductions in the SG&A expenses as a percentage of revenue. Lastly, we end the quarter strong, very strong, with a working capital having increased to 36.9 million on December 31st, 2019, for a current ratio of 3.2 to 1, compared with a working capital of 5.2 million and a 1.6 to 1 ratio on December 31st, 2018. Our cash on hand is at 22.7 million on December 31st, 2019, compared with 3.9 million on December 31st, 2018. Please note that we made a cash payment of almost 7 million for the acquisition of CDA System on December 10, 2019. Now, I'd like to bring your attention to this graph, which shows our ability over the years to deliver strong and consistent revenue growth. Since 2016, we've been able to achieve a compound annual growth rate of 52%, which is quite impressive. With the guidance that we will be reiterating, this growth rate will be maintained or may improve depending on our execution in 2020. Now let's look at our EBITDA reconciliation. I thought it would be especially helpful to look at the EBITDA reconciliation as it provides some context to our profitability. 2019 was an important year as we ramp up expenses to prepare the next leg of growth for the company. Revenue came in as expected, and profitability came in weaker than expected. This is driven by expenses we had to incur for strategic initiatives that we believe will support the next phase of growth. For example, we are implementing a new ERP system. We have implemented a new website, incur legal fees associated with our infrastructures initiatives, consulting expenses related to acquisitions, and recruiting fees for senior hires. Many of these were one-time costs, which we believe to be supportive of future cost savings and revenue and profitability growth. Furthermore, you can see that our net income for the fourth quarter 2019 was impacted by higher than normal depreciation, amortization of intangible assets such as engineer standardization and income taxes. All of these add up to 1.7 million in expenses that adds up to our EBITDA of 1.4 million. In addition, our adjusted EBITDA can be calculated by adding stock compensation, impairment of inventory, foreign gain and losses, and accretion of debt, which brings us to 1.9 million of adjusted EBITDA, which as a percentage of revenue is 14%. Lastly, I'd like to point out that the income tax came from our Italian and Toronto subsidiaries, which reported net income for 2019. Our operation in Quebec, Canada, do not incur income taxes as we have tax losses carry forwards available to us for a few years. Finally, I would like to give a snapshot of revenue by geography. We are happy to report that all our locations are performing well with triple-digit revenue growth across most of them. China led with more than 400% in revenue growth and is expected to double in 2020. Our Chinese team has done a tremendous job in 2019. We're especially happy to see that we are gaining market shares in the hydrogen segment in China. For 2020, We're expecting that our U.S. revenues will increase due to the recent U.S. dairy project orders, the added revenue of CDA system, and the revenue additions of our planned U.S. acquisitions for this year. Now I'll turn to Prabhu, our Chief Operating Officer, who will go over an update on the impact of COVID-19 on the operation. So Prabhu?
Yeah. Thank you, Louis, and welcome to everyone joining us on this call from your homes or your offices. I look forward to giving you an operational update, and I hope you'll find this helpful to better understand how the company continues to evolve as it positions itself for future growth. First, let me address the impact of the COVID-19 pandemic on the operations. As you know, we have operations in Shanghai, Milan, Montreal, Toronto, San Francisco, and some staff operating from Boston and Vancouver. As the outbreak spread in China and eventually got to Europe and North America, we had to contend with its impacts on our operations. The good news is that so far, none of our staff, about 160 employees around the world, have been directly impacted by this, and their well-being continues to be the main focus of the management team. In all our locations, we quickly transitioned to remote work environments and minimized the impact on functions like engineering, supply chain, and all the SG&A teams. The production activities in China were halted for 3 weeks in February, but we reopened on March 2nd and have been shipping products since then. In Italy, where the impacts of the virus are quite severe, the team was able to quickly adjust and transition to a remote work setting. However, given the shelter-in-place restrictions, the work on 3 of our biogas sites have been halted for the last 4 weeks. The positive news as of this call is that we are back in operation on the first site, and we should be able to get back to the other sites over the next 2 weeks and get the work restarted. Since March 13th in the province of Quebec, there's been a state of emergency, and again, we transitioned to remote work within a week or so. Given that we ship critical filtration and air dryers to many customers, including hospitals, and we are subcontractors to essential services like waste management organizations, we are deemed as an essential service, and we are able to operate our facilities and provide the support our customers need. In our subsidiaries CAI and CDA, the service teams continue to provide essential service to essential businesses, while the rest of the teams are supporting them remotely. In summary, I'm happy to say that I'm quite pleased how the leadership team at the various locations have responded to this crisis and collaborated with each other through this process. If there's a silver lining to the situation, it has brought the management team closer, and we expect to come out of this with a stronger Xebec team. Before we get into the operational highlights of 2019, I wanted to spend a few minutes on what we've been doing at Xebec on the product development side over the last 2 years. We reorganized our product offerings into 4 product platforms: biogas plants, PSAs, natural gas dryers, and compressed air and filtration products that all share the core adsorption technologies and are designed with the modularity and scalability. A lot of effort of the team has gone into standardizing these products so that we can position them for volume production as the market evolves. Now, coming to the operational highlights of 2019, I want to reinforce what Kurt mentioned at the very beginning of the call, that our success in 2019 was a team effort with all the functions in the company doing their part well. Our sales team was focused on closing deals with customers with a strong pipeline of projects or fighting for projects that will lead to a significant market opportunity in the future. You're all aware of our activity in the biogas, hydrogen, compressed natural gas, and compressed air industry. However, some of the interesting projects that we are working on also involve CO2 capture, purification of syngas from gasifiers, hydrogen reformers for fuel cell applications, and helium and argon purification solutions. These are all markets that can be of significant revenue potential in the coming years. The sales team achieved more than $53 million in bookings in 2019, and as you can see from our backlog number, we're quite well positioned for 2020 revenue and part of 2021. On the manufacturing side, our work has been focused on wrapping up our production activity and our supply chain while maintaining the quality of the products. In 2019, we had a 300% increase in PSA valve production, which amounted to approximately 1 PSA system per week. We also initiated the activity on implementing a global supply chain so that we can ensure that the Xebec products have the same quality and performance in all regions, and we can leverage that supply chain appropriately. Supply chain management will be a key focus for Xebec over the next few years to improve lead time and quality while reducing the cost of the product. We have also established a customer care function that will be responsible for site installations, operation and maintenance contracts, training of the new service providers we're bringing on, parts and warranty management. As you probably know, most of the capital products we sell have a minimum life of 10 or 15 years, and there's significant revenue and margin opportunity to service these plants. Our acquisitions of CAI and CDA and integrating them within our service network is a part of this strategy. Lastly, we continue to invest in our R&D to improve our products and adsorbent technologies, and we'll communicate further on these activities over the coming quarters. As Louis mentioned, we're also implementing a new ERP and CRM systems, which should be completed in 2020. And as you can see, 2019 has been a very busy year for Xebec operations. Now I'd like to get into some specifics of each segment, starting off with the clean tech product. As the main driver of our revenue growth, we were happy to achieve our revenue targets for clean tech for the year. Our revenue grew to $37.8 million compared to $14 million in 2018, which represents an increase of 140%. In Q4 2019, we announced an LOI with a partner which now has been converted into $27 million of U.S. dairy orders in multiple U.S. locations, including California. This increased adoption is reflective of the market realizing the advantage of that Xebec offers through its proprietary technology. In particular, our PSA platform allows dairy farmers, landfills, and municipalities to achieve low project lifecycle costs, which can be very significant over the 20-year life of a project. We are in a very fortunate position to have a strong backlog for 2020 and hope to continue to building on our quote log, which is close to $1 billion, and backlog over the next few quarters to prepare for 2021. Winning contracts in new regions and applications will be a key part of the strategy. Over the last few years, we have done well competing with membrane-based upgrading technologies for biogas flow rates for 600 SCFM and higher. However, we had a gap in our product portfolio for small-scale biogas upgrading solutions, which was mainly dominated by the membrane solutions. So we are very excited about our new product, BioStream, which is a modular, fully integrated solution for biogas flows below 300 SCFM. We are deploying many of these units in North America over the course of this year and will be in Europe early next year. For example, in France, there are about 1,800 applications for RNG projects, and it's expected that the vast majority of these projects will be within the flow capacities of BioStream. This product will be a significant revenue generator for Xebec over the next few years. Our hydrogen business under Clean Tech product portfolio also continues to grow nicely. Xebec has one of the most compact and cost-competitive hydrogen purification PSAs for byproduct hydrogen purification or small-scale steam methane reformers for fuel cells. We are seeing strong growth for hydrogen purification orders, particularly in China, and we will be expanding our hydrogen offerings over the course of this year and emerge as a credible participant in the emerging hydrogen energy business. Our next segment is our industrial service and support segment. As a reminder, this is Xebec's legacy business before we got involved in the clean tech space. We are expanding this business through acquiring profitable businesses that are located in regions that are central to our clean tech deployments. For example, our first acquisition, CAI, is located close to Toronto, where we are doing 2 biogas projects. And our second acquisition, CDA Systems in Livermore, California, was done in conjunction with our California U.S. dairy orders. This strategy will be key to supporting our continued revenue and EBITDA growth, and we expect to acquire 2 to 3 more companies this year. We're also happy to communicate that our performance of CAI in 2019 was exemplary. Their revenue growth was 35% year over year, exceeding the goal of 20% that was set for the management. We believe that our strategy of aligning our clean tech and industrial businesses is a competitive advantage and supplementary for each business segment. Finally, I'd like to talk to you about our third business segment, the Renewable Gas Infrastructure Initiative. Since 2018, we've been working towards developing high-quality renewable gas assets, and along the way, we've been able to identify the appropriate position for us in the value stream. One of the major learnings was the most project developers in the biogas market are limited by the upfront risk funding that is required, and hence many projects take a very long time to get to a funding stage. In addition, we feel that the best approach is to form strong partnership with credible players in the value stream and align all the stakeholder interests. Going forward, Xebec will be a financial investor and technology partner in these RNG infrastructure projects. We will provide capital, equipment, and operational support for the upgrading equipment. Xebec will facilitate the environment in which project developers can develop these projects and we'll co-invest into these projects to provide the financial backing that is needed. This approach also gives other investors confidence in the viability of the projects, as a major technology provider is a co-investor and shares the project risk. At the start of this year, we finally announced our first project with several others in the pipeline. The first project is located in Quebec, requires an investment of $28 million, and is expected to be commissioned by mid to late 2021. It's an integrated facility to process various organic waste for the production of renewable natural gas and biofertilizers. We will process about 45,000 tons of organic waste per year and generate 150,000 gigajoules of RNG and 7,500 tons of biofertilizers per year. There are 3 revenue streams for this project, which are renewable natural gas sales, tipping fees, and the biofertilizer sales. Tipping fees are revenues generated for accepting the organic waste from waste collectors who historically would have taken this waste to landfills. We expect unlevered returns of 12 to 15% on the project. And as mentioned before, we'll also receive the benefit of selling one of our RNG systems to the project, and we'll enter into long-term operations and maintenance contracts with the project operators. Furthermore, I'm very excited to say that we are very close to signing a significant co-investment partnership to invest in multiple RNG projects in Canada. We expect to announce this partnership within the next few months and allow us to scale up our efforts to invest in high-quality renewable gas assets. Currently, we are incurring costs to develop the first project, in addition to the costs incurred for establishment of the co-investment partnership. We look forward to providing more updates on these activities over the next few months, as they will become key drivers for long-term success of this segment, providing Xebec with predictable recurring revenues and profitability. This concludes the operational update, and I'd like to invite Kurt for his final comments and conclude with the outlook for 2020. Kurt?
Yeah, thank you, Prabhu. 2019 was another good year for shareholders. Xebec has been chosen for the second time as a TSX Venture 50 company, a program by the TSX Venture Exchange to showcase the top 50 performers for the year on the exchange. We also celebrated some other milestones throughout the year, one of which was ringing the opening bell for our 10-year anniversary on the Toronto Stock Exchange. You're looking now at a picture of our team opening the market at the TSX offices here in Montreal. Our share price in 2019 increased over 190%, which was in combination with a 330% increase in market capitalization to $180 million. Alongside, we saw a 350% increase in trade volume with almost 62 million shares traded and a 950% increase in trade value to over $100 million for the year. As of today, Xebec is covered by 9 analysts, 6 based in Canada and 3 out of the US. These positive capital market developments have allowed Xebec to conclude 2 successful bought deals in 2019, raising gross proceeds of almost $35 million. As part of our evolution, we are now on track to graduate to the TSX main board in early Q3 this year. This will help provide more exposure for the stock and allow more institutions to invest in the company. Overall, I'm very happy that we have been able to significantly increase shareholder value over the last 3 years. In 2016, we ended the year with a share price of 6 cents. And at the end of 2019, we ended the year with a share price of $2.15, a 3,500% increase over a 36-month period. In 2019, we have demonstrated that Xebec has access to the capital markets, can fund its growth, and going forward, we can utilize our stock as future currency for potential acquisitions. I would like to spend a few minutes on looking past COVID-19. The immediate effects of COVID-19 will be a recession that will significantly depress demand, not only in the short term, but for many months and possibly years to come. The impact will be felt by everyone. One of the main lessons we need to learn out of this pandemic is that we need to be prepared for the next black swan event. If we do not take preventative steps, if we do not listen to the experts and scientists And if we do not prepare, we will pay a heavy price, a price like the one we are paying right now. As with this pandemic, climate change has the potential to be a similar scale event. Scientists and climate experts have been unanimous in warning us for years about the significant negative impacts of climate change on our health and our economy. Unfortunately, our response so far has fallen far short of what is needed. Given that governments will have to spend significant amounts of money to stimulate the economy, as the pandemic runs its course, I think it is reasonable to expect strong investments into renewable energy and clean technologies. The Canadian government is already considering this kind of stimulus, and Xebec should be well positioned to benefit from these potential opportunities. Given the current conditions,
Sorry, guys. It looks like we lost Kurt. Prabhu, can you take over the slide for managing guidance?
Yeah, I will. Thank you.
Okay, am I back?
You're back.
Yes, you're back. Perfect.
Am I back?
Yes, Kurt.
Yes,
Yeah.
Okay, sorry. I just start out again. Given the current economic conditions, we are very fortunate to have been able to reaffirm our guidance for 2020. We have enough orders in backlog and visibility into operations to confirm our outlook. We are expecting $80 to $90 million in revenue. Gross margin is expected to remain the same at around 30%. SG&A as a percentage of revenue should come in below 20%. EBITDA is forecasted to remain in the range of 11 to 13%, and net income is targeted at 7 to 9%, which translates into approximately 5 to 8 cents per share. In terms of how the revenue will be split, we are expecting $50 to $55 million in the cleantech segment and $30 to $35 million in our industrial service business. Segment margins are budgeted to be in line with our historical levels. At this point, let me reiterate how robust our financial position is, with approximately $25 million in cash as of today and another $17.2 million in warrants to be exercised by July 1st. In other words, in the next 2.5 months. Combined with our quote log of close to $1 billion and the backlog of almost $100 million, we are very well positioned relative to other companies in our industry and worldwide. On the last slide of this presentation, I'd like to go over our high-level 2020 strategic objectives for each segment. In our cleantech segment, we are aiming to win additional contracts to fill the backlog for 2021. As mentioned, we have enough orders for this year, and we will be booking most additional orders into 2021 and beyond. We would like to continue the momentum in order flow, but clearly we need to see how our potential customers will position themselves over the next few weeks and months given the current situation. It will be interesting to see if they will place the orders as planned or will hold on to see how the crisis plays out. We are really excited about how our new containerized biostream system will evolve, which will allow us to expand into new markets and geographies for smaller flow applications. We see this as a key step to gaining further market share and solidifying our leadership position in key markets. Lastly, in conjunction with launching BioStream, we would like to strengthen our presence in Europe. Our market intelligence has shown that small-scale applications are a significant market in Europe, and consequently, we would like to strengthen our position in core markets and add 1 or 2 more additional markets. In our industrial segment, we are continuing with our M&A strategy. Our growth margins in this segment require some work, and we are planning further product mix diversifications and leveraging our increasing purchasing power to reduce product costs. Lastly, we would like to reduce the cost of capital for our acquisitions. The recent interest rate reductions by the Bank of Canada and the Fed are already helping us in this regard. We are currently in negotiations for a line of credit for acquisitions. Our infrastructure segment continues to evolve steadily. As previously mentioned by Prabhu, we are planning to announce several more RNG projects over the next 12 to 18 months. We are also looking forward to announcing our co-investment partnership, and as this will be a significant development for the industry here in Canada. On the corporate development side, we like to graduate to the TSX main board by July, August this year. Over the last 10 to 12 months, more and more investors have asked us to consider a move to the main board, and early this year, our board has approved the move. We are now actively working on becoming compliant with the requirements for an uplisting, which should be achieved during Q2. We are also looking to expand our board from 5 to 7 members and become more diverse in our board composition. Lastly, we have commenced a review of all our essential and non-essential expenses to make sure we are only spending money on need-to-haves and not on nice-to-haves. With that, I'll turn it back over to Brendan to proceed with the Q&A.
Thank you, Kurt. With that, we'll open up the floor to questions. Please note that you may ask a question at any time to the right in the console. We will wait a moment for questions to queue up. Great. So we have one question from Jason Tucker from Paradigm Capital. Prabhu, can you talk about the potential delays in the contracts that we've been working on so far and how that might impact guidance? And can you talk about how confident you are in being able to hit the guidance for the year given the coronavirus uncertainty?
Yeah, in terms of if you look at the biogas industry and our deployments there, the majority of the deployments are really on-site work is really Q3 and Q4. So a lot of the work that's going on now is mostly construction of the product and the supply chain that's delivering that. So at this stage, we feel reasonably confident that our deployments will go on schedule and we'll be able to recognize the revenues on that. So however the pandemic grows and it continues in Q3 and Q4, I think the adjustments will be more of a timing issue rather than a loss in revenue. When it comes to the PSA deliveries that we are working on in the hydrogen space or the other markets, other applications, so far we have not seen any delays from our customers. The flip side is that we get a lot of calls from customers to make sure that we are delivering on time. So I think we have not felt any impacts in terms of delays for the full year 2020. In terms of actual shipments, there may be adjustments by a few weeks here and there, but that's mainly dependent on the logistics and the sites being ready and the construction queues being ready on the customer sites.
Great. Thank you, Prabhu. So we have another question from Amit Dayal from H.C. Wainwright. Does the revenue guidance include the contributions from the new acquisitions on the industrial side?
Yes, they do. We have a run rate on the industrial side currently of around $22 million, $22 to $23 million. So we need to add at least 2 or 3 additional acquisitions to hit our target of 30 to 35 million.
Great. Thank you, Kurt. We have another question from Amit and a couple of our other investors, including Sid. Can you talk about the certainty of the first build, own, operate project? What kind of contracts can come from that? And how are you thinking about the first project development and the future ones ahead?
Okay, can you repeat that question, Brendan?
Yes, no problem. Can you talk about the first renewable natural gas project and the certainty behind that, and how are you thinking about the next couple of projects moving forward?
Yeah, so on the certainty side, that project has progressed so far very nicely. We are obviously working with our partner, Baylor Biogas, on that. Applications have been made, permits application have been made, grant applications have been made. The design work is progressing. We expect that plant to be operational by mid next year, maybe a little bit later than mid next year. That is the current target. So as far as I can see, this is progressing on track. The next projects are dependent obviously on financing. As Prabhu has mentioned in his overview, a lot of those projects are suffering on not having the risk money available to develop the projects. Now, what we will make available is the risk money to develop those projects, because as you move those projects forward, you basically have to invest into permitting, siting, finding the feedstock, finding the offtake, all those things. If anything falls apart, suddenly you've invested quite a considerable amount of money and you have no project. So what will happen is, with the establishment of our more important partner, co-investment in partnership, we will make the risk money available to develop a multitude of projects. There's quite a good list of potential projects that we are following at this point.
Great. Thank you, Kurt. We have another question from Alan Richardson for you, Prabhu. In the order backlog, how much can be attributed to the repeat business of the service division versus the equipment sales on the clean tech side?
In terms of the order backlog that we have, I would say 60-70% of that is basically on our clean tech and PSA side, PSA businesses. And then you have the service business is probably, I would say 20 to 30% of that. In terms of repeat businesses, we get on the PSA side, especially when it comes to hydrogen, there's a lot of repeat business. Customers, as I said, when it comes to small scale hydrogen purification or small scale solutions, I think PSA, Xebec's the leader in that space. So there's a lot of, we have customers who have worked with us for the last decade on that. In terms of biogas, obviously this is an emerging market. We have repeat orders from a couple of the customers, but I expect to see that grow a lot more in the next few years.
Yeah, let me add here, out of the $100 million order backlog that we are having, and I think we are breaking it down in our MD&A, about 10 million comes from the industrial segment. So clearly our acquisitions have orders for equipment business that go into backlog, but the majority of our backlog is in the clean tech business. And normally the service businesses generate about 60 to 70% on the service and parts side, and about 30 to 35%, as I'm always saying, on the new equipment side. So a lot of the revenue that the service companies are generated are not reflected in our backlog. Only the equipment orders that they carry at any given point is reflected in our order backlog.
Great. Thank you, Kurt and Prabhu. Prabhu, can you also talk about the competitive landscape and how Xebec's proprietary technology compares to the others?
Yeah, so when you talk about our PSA technology and the competitors, is you have membranes. I'm talking about the biogas industry. There you have the membranes, water wash, and you have the chemical system, the amine systems. I think over the last 3-4 years, the two technologies that have kind of come to the surface are the membranes and the PSAs. And compared to membranes and PSAs, as I said, when it comes to large scale plants, PSAs are always have a distinct competitive advantage because membranes, the cost of a membrane system scales by the surface area of the membrane, and the cost of a PSA system scales by the diameter of the tanks that we use. So from pure physics, our products are more cost effective. When it comes to small scale systems, this is where membranes were doing a better job over the last few years. But now with our BioStream product, I'm very confident that we'll be capturing market share there. The other technologies, water wash and amine systems, they seem to have some challenges, and I think customers have begun to realize that. So the focus mainly has been on PSAs and membranes. And when it comes to PSA technology themselves, there are a few competitors. But when it comes to the novelty, the simplicity, and the size of our PSA and the reliability of the product, I think our product is definitely distinctly better than what I see with others. And it is reflected by the feedback from the customers and also from the order backlog that we have.
Great. Thank you, Prabhu. We have a question from Reveal from Canaccord. This is again for you, Prabhu. How do you see the cost of renewable natural gas changing over time as the industry scales and matures?
Yeah, I think this is a good question, because we try to think about that a lot, because, today, as you know, the pricing of RNG can anywhere from $15 a million BTU to $70 to $80 a million BTU in California. So the market obviously is supported by the attractive pricing that's there. But at the same time, what I see is that as we continue to standardize our products and actually make our products more cost effective, we should be able to make a good value proposition for customers, even if there's a headwind towards the RNG pricing. We don't see a significant change on that in the near term, let's say in the next 2-3 years. But further out, it's likely that just like solar and wind went through a depreciation in the pricing structure, we could see that in the RNG space. But our focus is mainly to reduce our cost structure so that we can continue to create value for the customers. And eventually, we want to get to a price of RNG where we can actually make cost-effective renewable hydrogen, as we see that as the next emerging fuel. So cost-effective RNG to convert that to renewable hydrogen through on-site steam methane reformers for hydrogen fueling. So that's kind of the next wave of activities for Xebec.
Great. Thank you, Prabhu. We have a question from Catherine for you, Kurt. Can you talk about the landscape when it comes to government subsidies, the renewable gas mandates, and how that might be impacted by the coronavirus and the economic situation?
That's a difficult question. Obviously, at the moment, you have basically two instruments that is driving a renewable natural gas, either those renewable gas mandates that the gas utilities implement, or you have a low carbon fuel standard like in California, where you then can trade the certificates. Now, going forward, what will evolve, and I've spoken in the presentation a little bit about it, what will happen to the government coming out with their stimulus spending, that might change the landscape. I mean, I've clipped out an article from the Globe and Mail that was in there, I believe it was April 9th, where they're already talking, and in this article they're talking about, as Catherine McKenna, who is the infrastructure minister, and Jonathan Wilkinson, who is the environment minister, basically been tasked to look at how they can start stimulating the economy, but also by spending on climate-related activities. So I'd be very hopeful that we are seeing some very interesting programs come out that should bode well for renewable natural gas. Now, will the same be happening on the federal level in the U.S.? I doubt it. On a state level in the U.S., yes, I would hope that we're going to see a program, and I would assume the same probably will happen in Italy and in France. Now, Italy is a little bit of a delicate situation, because Italy has an enormous debt load. They've announced, I think it is now almost 2 years or 1.5 years back, that they have a 4.7 billion euros subsidy program for renewable natural gas. Now, we will see if they can deploy that money, given everything they have to do. Now, if the EU steps up and supports Italy, what I expect, I would hope that we're going to see increased investment into this space, because, again, our climate change is the next potential huge crisis we're going to be facing, and every dollar spent now on this should be beneficial for us later on as a society.
Great. Thank you, Kurt. Our next question comes from Jeff Silver from Corrado Financial Group. So it's the early days in the COVID-19 environment. But with Xebec's strong balance sheet, can you talk about how you're thinking about acquisitions and assume that potential sellers may be driven down to the table? How do you trade off what may be a buyer's environment with the stress of the potential acquirees?
I'll let you answer that, Prabhu.
Yeah, I think it's a very interesting time. And on one side, you're right. It looks like this could be a buyer's environment. So our focus as we look to acquire companies, as I said, the drivers behind it is they have to be strategically located to where our clean tech deployments are. So we look beyond just the COVID situation now. We want to make sure that we have good companies, good management team, because we typically like to keep those management teams intact for a few years. So we want to look at companies that have, again, profitable companies with a good management team, have the right service infrastructure that can support the growth of our clean tech service business over the next, say, 3 to 5 years. That's really the driver behind how we look at these companies. And I completely agree that this COVID situation may actually create some unique opportunities for Xebec to use its balance sheet and the funding resources that we have to actually acquire some really good assets over the next 6 to 8 months. So our team is motivated about it. So that's why we reconfirmed what we just said. We're looking to acquire 2 to 3 companies, but I think it actually gives us an opportunity to do that this year.
Great, thank you.
I want to just add, for Jeff, I want to just add, it's not only the roll-up strategy that we are pursuing. I think there's also opportunity that might be a little bit more strategic and more important to Xebec. We will need to see how this evolves. There's no rush for us over the next 12 to 18, 24 months. I think there will be opportunities for Xebec to look at some potentially very strategic and worthwhile acquisitions as we move forward. Now, we'll assess it and we'll see how it goes. But I think that the pricing that we will be seeing will be attractive. Even today, if I look at some of those companies I'm following, the pricing looks very, very attractive even today.
Great. Thank you, Kurt. So we have a follow-up question from David Gazetta from Raymond James. Can you talk about how the pricing has changed from what you've seen so far, maybe provided in the context of dollar amounts or different valuation metrics?
In terms of the acquisitions, Brendan?
Yeah, so given the current environment, how much more attractive are these acquisitions becoming? Are you able to quantify that?
Well, I think it's a little too early to quantify it because we have a pipeline of acquisitions that we are working with, and there's a lot of back and forth with, I would say, 3 or 4 companies that is going on right now. And also, it also helps us to structure our deals slightly differently, given the uncertainty in the 2020 revenue projections that they would have. So it gives us, I think we're in a position to be able to make different types of offers that are more attractive for Xebec.
Yeah, again, the acquisitions, we are obviously looking at paying a fair price for each acquisition. What we are tending towards at this point is also to use some of our shares as a currency in those acquisitions. It obviously makes a lot of sense for us to conserve as much cash as we can as we move forward, because even if we think this thing only lasts maybe 6, 12, 18 months, who knows? We don't know. So we want to make sure we have enough financial resources as we move forward. And I think it would be prudent for us to combine those acquisitions. They have an earn-out component. They should have a certain equity component, in other words, share component from Xebec. And then there's a cash component. And ideally, this cash component, we want to debt finance. Debt financing is becoming increasingly more affordable for us. So that's how I would look at that. But cash preservation, as I said before, cash is king. And we want to make sure we have as much cash as we move forward.
Great. Thank you, Kurt and Prabhu. We have another question from Eric Stein from Craig-Hallum Capital Group. Can you describe and characterize the partner you are close to announcing? Will this be an exclusive agreement? Can you also discuss the pipeline with this partner and other potential partners? Prabhu, this is for you.
Yeah, I think as we indicated that we expect to have an announcement in about 2 months. So I think we want to be a little careful about what we talk about it, what we say about it today. But in terms of a partner, this will be a strong financial partner who will work with Xebec in terms of developing projects in the Quebec region. And I think that's the initial focus right now is Quebec, because it's closer to where we are, where our headquarters is. And then once we expand in Quebec, I think beyond that, we have other discussions going on in other regions of North America. We also announced a partnership in Europe earlier. I think it was last year. That continues to exist for us, and we have opportunities to co-invest with them in Italy and France.
Great, thank you. We have another question from Ahmad Shah from Beacon Securities. Prabhu, can you talk about the movement in backlog? Has there been any other wins besides the $27 million that was announced in California?
So there have been, in terms of backlog, there have been a number of contracts that were awarded, mostly in PSA type activities. On the biogas side, we are very close on a few projects, and hopefully we'll be able to announce some of them in the near future.
Yeah, I think what I would like to add here is, as you know, in Canada, only 2 provinces at the moment have a renewable gas mandate, British Columbia and Quebec. Enbridge in Ontario has now applied for a voluntary RNG program that should become hopefully operational in the second half of this year. But more importantly, Fortis has just recently announced that they have received approval from the British Columbia Utility Commission to move forward with buying renewable natural gas out of province. So this will allow now a number of projects Xebec has been working on that are located outside of British Columbia to move forward, because the offtake agreements can now proceed, and those offtake agreements are obviously with Fortis. So when we are talking about, and I was speaking about that we are close to closing some of those contracts, we will need to see if the clients will now place the orders, or if beyond getting an offtake agreement, they're more hesitant about the future and hold back on placing those orders. I think over the next 4 to 8 weeks, we should see how the order situation progresses.
Yeah. Also, I think there are, again, because of the COVID situation, there's been some delays in activities in Europe too. I mean, there's some very exciting opportunities for us in Italy that we are working on. China is back. I mean, now, although there's some restrictions on travel for the sales team, but they are now in a position to start closing some orders, so we should see some traction there. As we mentioned earlier, China had a fantastic year. We came into 2020 with a very strong backlog in China, so the revenue risks there are pretty low. But in Q2, we should be able to see a lot more closings in around the world. I think we should begin to see the progress there.
Great, thank you, Karan and Prabhu. So to build off that, we have another follow-up question from Ahmad. So it looks like we booked some orders in the last quarter in China. Prabhu, can you provide some additional color on how that's looking?
Yeah, in China, it's interesting how successful we are. Like I said, again, Xebec has a very unique PSA, and when it comes to gas purification, especially in the hydrogen space, we are leaders there. So in China, there are 2 segments where there seems to be a lot of growth. One is byproduct hydrogen purification for fuel cell applications. As you know, China has been pushing hydrogen fuel cells for the last year or year and a half, and that is triggering a lot of demand for low-cost hydrogen. And one of the ways of making low-cost hydrogen is byproduct hydrogen from chemical processes, and that's where we are seeing a lot of traction. The second segment where we are also seeing a lot of activity is in the refinery industry. So when it comes to making chemicals, there's some gas cleanup technology that is required. And so we are selling a lot of these smaller scale hydrogen purification solutions in downstream refinery chemicals. So between the 2, I think we did almost 20 million in sales in China last year. So those 2 segments are growing nicely for us. We expect the same. We are seeing a lot of traction in reformers, steam methane reformer-based solutions for hydrogen generation in North America. So we have a lot of customers in that space. As you also know, we have a partnership with a company in Korea where they're building like 500 kilogram a day or half a ton reformers for fuel cell applications. So we sell PSAs to them. So that segment, as it evolves, as heavy duty fueling and heavy duty trucks or fuel cell trucks are on the road, there'll be a lot more demand for small scale hydrogen generators. And I think Xebec is well positioned, not just on the purification side, but also on the reforming side of things. So that's a segment that will continue to evolve for us.
Great. Thank you, Prabhu. So we have a question from Bob McWhirter from Selective Asset Management and another one from Ahmad. What is the expected selling price of the BGX BioStream system? And can you provide some color on sort of what the go-to-market strategy is, which geographies are the focus, and is that only exclusive to Europe, or is it also going to be in North America too?
No, the BioStream product is a global product. I mean, we're obviously launching that in North America today. It's priced very competitively. We know what the market pricing is for membrane-based systems in this space, in this flow rates, and we are pricing it competitively. But also, this is a reasonably, I mean, we're in terms of a margin structure, we expect it to be pretty good for us. But a lot of that obviously comes with scale. So as an example, in France, over the last couple of years, there have been between, I would say, almost 50 small-scale systems sold. And so Xebec did not have a product in that space. And as a result, we were not able to capture the market. So you can, even if we got 10, 15, 20% of the market share going into next year, we can see a significant revenue bump coming from just the BioStream product in that region. We expect that as the larger projects are put in place, the next wave of projects in Europe and also eventually it'll be in North America too, will be the small scale systems. So our focus is really to standardize the product, set up the supply chain globally, and drive the cost of the BioStream lower so that we can go after all these markets. And then beyond the 300 CFM, we see a lot of interest in really small farms, which is maybe 50 to 100 SCFM, especially we have a lot of requests for that in South America too. So we'll be looking at a portfolio of products, what we say integrated BioStream solutions. So what we have launched right now is the first wave of BioStream, but there's going to be many models of BioStream that will come out targeting different regions and different flow rates.
Great. Thank you, Prabhu. We have a question from Fred Tremblay from Desjardins. What are your expectations for revenue and earnings contribution of your first infrastructure project in 2021?
Well, let me answer that. So on the infrastructure project, we're anticipating that we're going to invest about 20 to 30% into the equity of the project. So there's going to be a return out of the profit generation of the project. We are going to have the sale of an upgrading system, and we're going to have the revenue out of a service and operations agreement. Now, the project is only slated to start mid to late 2021, so the impact on our revenue in 2021 will only be in relation to the equipment sale. The profit generation or the service and maintenance contribution will be negligible. But going forward, obviously, each one of those service contracts is an important part of our strategy to generate more stable recurring revenue. Yeah. And as we've announced, the IRR on those projects is initially 12 to 15%. We have a hurdle rate for those projects, which sits at 10%. So yeah, I'm quite happy if we can attract those projects, work with waste companies, municipalities, gas utilities, project developers, to participate in the rollout of those projects. And Xebec can be a co-investor to give more confidence to the other investor base. I think it's ideal.
Great. Thank you, Kurt. So we have a couple more follow-on questions from Andre and Andrew Hood from M Partners. Can you talk a bit more about maybe give some examples of the key players in this build and operate infrastructure segment and the potential risks that these projects may not go forward given the current business environment?
So in terms of build and operate, if you look at the value stream, you have obviously the feedstock supply, then you have the partners that will make the digesters themselves, and then we have the upgrading players like Xebec, and then you have the downstream off-takers and also customers that could take the fertilizer. So there's a range of players in each part of the value stream. So over the last year, what Xebec has done is basically map that out and look at all the players that are there in the different regions and try to identify partners for each one of those parts of the value stream that we could partner with in the different regions. But as Kurt mentioned, and we talked earlier, a lot of the project developers are putting together these projects. They'll have limited funding, and in terms of developing a project, you need to get the partners on board. You got to get the contracts in place with them, and then you got to take the offtake agreements and the feedstock agreements. So putting together a project is almost like a 12-month process, 12 to 15-month process. And what we have done is try to identify partners that we can work with and also provide the necessary funding and provide the funding resources so that we can take this to a full scale, get through the development phase and get it to full funding. So we have partnerships developed and also identified in different regions of the world. And the one in Quebec is probably the one that's moving forward the quickest. And that's also because we want to do it in a region where we are close to it and we are headquartered there. So I hope that answers the question. I mean, we would have to get into every region and talk about the various players to be very specific about this.
Well, I want to add maybe here, for us, it was also a process of determining where in the value stream do we sit. What we realized is, and what some of our potential customers brought to us, well, are you becoming a competitor to us in going into project developers? And we realized we don't want to be project developers. We want to be partners to project developers. So we needed to find our space in the value chain, which I think we have now. We have a business model that allows us to co-invest, sell the equipment, get an operation maintenance agreement. So I think and help the industry grow, because by us and our financial partner making risk capital available for the development phase will be very important for a lot of people to be able to push their projects forward. And it will still allow them to invest into the equity of the project, while we co-invest if it is required or desired, but we are not pushing this. You want it, we are there. If it's a good project, if it meets our hurdle rates. So clearly, we want to make sure that the market understands we are not a competing project developer. We are basically a facilitator. That's how I would say. I would like to position that.
The last comment about that is the following, is that if you look at a lot of the biogas projects from the past, a number of them have failed because the technology provider has walked away from them. And what we want to do is make sure that we are there in the project and we have a stake in the project and we get some long-term returns on that. So all the other participants and all the stakeholders have the confidence to make the investment. So we have skin in the game is basically what it is.
Great. Thank you, Kurt. We have another follow-up question from Eric Stein. Can you talk about the expected linearity throughout 2020 with Q1 already done and acquisitions as part of the plan?
Yeah, this is a good question because this is what we grapple with day to day on the operational side. So if you look at our revenue projections for the year, we are reiterating revenue projections. We feel pretty good about it because when you look at the backlog and the projects we have, we see a pathway to get to the numbers we have set. The question becomes whether it's how does it distribute it across the various quarters in the year. And this is always this is something that the team is constantly working with the supply chain and with the customers to make sure that we're able to deploy the products as planned. So it's difficult for us to tell you exactly how the revenue is distributed between Q1 and Q2, but we definitely see a clear pathway to the 80 to 90 million that we have talked about. So that's I hope that answers the first part of the question. And Brendan, what was the second part of it in terms of the acquisitions? We are actively pursuing 2 to 3 acquisitions right now. So it's it's a matter of now going through the due diligence and executing them. So some very, very attractive companies will add a lot of value to Xebec in terms of not just providing the service infrastructure, but also a product portfolio that could be used through our entire service network that we are establishing. So I think there's no slowdown as such in terms of activity in the acquisition space. But as Kurt mentioned a few times now, in this environment, cash is king. So we always make the important decision in terms of how we structure those deals so that we're not exposing ourselves from a cash flow point of view.
Yeah, I want to add here maybe just 2 sentences. One is historically Q1 was always the weakest quarter or one of the weakest quarter, and we strengthen as we go through the year. That's what you see when you look at our quarters very often. So I would expect it to be similar in 2020. And then when you look at the revenues from acquisitions, clearly if we are having a revenue rate at the moment in our industrial segment of about $22-23 million, we need to acquire about $10 to $15 million this year to get to our guidance of $30 to $35 million. If you assume that we are now in Q2, that we can close maybe the acquisitions over the next 2 to 3, 4 months, that would mean that in the second half of the year, we need to get in at least $10 million in additional revenue, $10 to $15 million in additional revenue out of those acquisitions. That implies that those acquisitions overall generate about $20 to $25 million, $30 million in revenue. Those 3, 4 acquisitions we are looking at. I think that gives you a little bit of a guideline as to how we look at those acquisitions and the revenue that we should be getting in from them.
Great. Thank you, Kurt and Prabhu. We have another question from Andrew Hood for you, Louis. So he's commenting on the bump in accounts receivable for Q4. Is this just a timing on collections and the increase in revenues? And has there been a significant portion that's been collected, or are there any concerns on collecting the money in today's economic environment?
Well, as we said, the accounts receivable went up, from, we had the revenue last year of 20 millions, this year 49 millions. So that's, the accounts receivable are going up, and this is normal. We don't see any issues for collecting the amounts. Any of the ones that we have concerned, they were provisioned. So it's just a matter of time. Don't forget that these contracts, sometimes we have to deliver to there's some performance to be finalized on them to collect. So it's just a matter of time. So, but, by looking at all the receivables, if you go to China as well, China increased, and the collection in China is always longer. So we did the evaluation. We don't foresee any issue of collecting these.
Maybe Louis, you also speak about the percentage of completion accounting that impacts that.
Well, I can add to something. We have always 2 categories. We have the trade accounts receivable that we have invoiced, but we have also what we call the accrued receivable, which means that in some cases, when we perform more work on a job that we have billed a customer, then we have an accrual to receive. So that's another part of the explanation. So we're working very hard, and we're ahead in many cases in some contracts in terms of work we perform on the job versus what we bill to the customer, which because we're doing the accounting of what we call the POC accounting, progressive accounting. So that explains also why that has increased. But that's basically the answer, and there's no worry about collecting these receivables at this point.
Great, thank you, Louis. We have a couple questions from Calvin and Gary in regards to the quote log. Prabhu, can you talk about how the quote log is shaping up and your sort of expectations on the conversion of that into the backlog?
Yeah, I think that as we have mentioned a few times, the quote log is very large. And we are quoting. If you look at how the distribution of the quote log, obviously when we quote for landfill projects in North America or Europe, those typically are a much larger dollar value. Then we are doing a lot of in terms of the digesters and wastewater treatment facilities, and again, both in North America, Europe. Those dollars are typically, you're talking about between $3 to $5 million per project. So those are the two big categories there in terms of the biogas market. There's obviously a smaller part of that is also the hydrogen PSAs, and there's a good number of those also building up for both fuel cell applications and also refinery applications. In terms of conversion of the quote log to orders, typically our target, as we always say, is that we want to be able to close a decent number of projects in every region every quarter. That's kind of how the sales team is focused. So and like we said, in 2019 we closed about almost 53 or 54 million dollars in orders, and we expect to exceed that in 2020. That's the target that sales teams have. In terms of quoting, the quoting activity we did not see any slowdown in the first quarter because of the virus situation. The team's been as busy as ever. We'll also see a lot more activity now starting in Australia. So that's a new market area which we are looking at. So that's a new area that's developing, and Australia is investing a lot in not just in biogas, but hydrogen is, I think, is a big market, and it's evolving rather quickly. So we have supplied, actually, for example, we have supplied PSAs there for a gasification project. So that's a region that's an interesting region, and we're trying to figure out exactly how to play there. But RNG, hydrogen, and PSAs for gasification are three markets coming out from that region too.
Great, thank you, Prabhu. We have another question in regards to how you're thinking about South America. Is that an area of potential expansion too?
Yeah, we just completed the commissioning of a PSA system in South America. You know, many of these competing technologies that are there, we talked about membranes and other technologies. Many of these competing technologies are not able to achieve the gas purity required to inject in the pipeline. So sometimes we supply purification systems to put after our competitors' technologies to actually get it to the gas spec. And so we had just commissioned one of the plants there in one of the largest landfills in Brazil. And that project was successfully done. There's a lot of demand from Brazil that we see a lot of requests for very small scale biogas solutions. And so we've been looking at it. So that will be a mini version of BioStream. So there's a product offering in BioStream that is smaller than what's being launched today. That's in the cards. The timing of that is not exactly sure, but we are working with some very significant players in Brazil for that market. So then there's some activity in Argentina and Colombia, but these are all opportunistic, and we are a little bit cautious about spreading ourselves too thin because, you know, when you supply a plant, you need to provide the service infrastructure behind it. So Brazil definitely is a key market focus for us. And I'm hoping that the second half of this year we'll have a lot more activity down there. And we have a partnership there in terms of a service support that's quite stable and strong. So as we start deploying products there, we feel confident that we can service them.
Great, thank you for that. We have a couple of questions in regards to headcount and how the hiring of senior management is going. And are there still positions that need to be filled for you, Prabhu?
Yeah. So, you know, as Kurt said, the last 3 years have been quite an effort by Kurt and Louis and myself trying to build the organization. A major part of my time has been in bringing in the right people in the company. So we have a series of directors that we brought in terms of engineering and supply chain and manufacturing. And then very recently, we brought in a vice president in operations, who's helping me a lot in terms of operating the facility in Blainville in Montreal. So that was a very strategic hire. There are probably a couple more that are needed as we expand in the various regions in the world that are more managing locally in those regions. But I think we have filled, I would say, 70 to 80% of the key positions in the company. and there are a few more that we'll either promote from internal resources or we'll have to go out and hire. I did mention supply chain as a key focus for the next few years. I think the company in the biogas industry that has the best supply chain is going to win the business. So that's going to be a big focus of my activities over the next few years.
I think we might have lost Brandon here.
Yeah. So I think maybe it's about 12:20.
Yeah, I think we should probably wrap it up, especially since we lost the host.
Yeah.
So thank you, everyone.
Yeah. You have some concluding comments? Yeah. Go ahead.
Yeah. So thank you, everyone. It was a pleasure having you for our third investor webinar. I will be reporting our Q1 20 numbers by mid to end May. And I look forward to speaking to you then. And in the meantime, keep safe and well. And that concludes our webinar. Thank you very much.
Thank you.
Thank you all.
Have a good day.
Have a good day.